Hi, I'm Michael Taila, Director of Fixed Income at City National Rockdale, and welcome to this month's edition of Fixed Income Perspectives. In what is shaping up to be a strong year for fixed income, the third quarter delivered another period of broad-based positive returns across all major sectors. Performance was supported by resilient corporate earnings, easing trade tensions, as well as prospects for a rebound in economic growth. By quarter end, however, signs of labor market cooling and subdued inflation allowed the Federal Reserve to reduce the policy rate by 25 basis points. As a result, U.S. Treasury yields declined modestly across the curve, with year-to-date levels remaining lower overall, most notably in the shorter policy-sensitive maturities. Within the investment-grade markets, municipal bonds sprung back to life with a 3% return in the quarter, outpacing most sectors, including U.S. Treasuries and corporates. This performance was primarily driven by steady demand for longer duration paper, as valuations for tax-adjusted yields became very attractive for investors seeking tax-efficient income. Like municipals, credit spreads, or the extra yield earned for risk, tightened in the corporate bond space, helping this market gain further ground, with year-to-date returns close to 7%. While global markets returned just 60 basis points in the quarter, performance to date remains healthy and continues to benefit from early year weakness in the dollar. Turning our attention to global and U.S. high yield, these markets returned approximately 2.5% in the quarter. On a year-to-date basis, global high yield continues to outperform, helped by attractive starting yields, durable credit fundamentals, as well as early year dollar weakness. Institutional flows have also been positive, reflecting confidence in this market. A bright spot during the quarter was U.S. high-yield municipal bonds, which turned positive on the year in September with performance of about 2.6%. This was the highest monthly return for the period since 2013. With taxable equivalent yields above 9.5%, high-yield municipals remain a highly competitive alternative to taxable options. As we enter the final months of the year, the shutdown has been top of mind for investors, but it has not materially affected the financial markets to date. In the near term, we anticipate little impact on bonds, with the debt ceiling having already been addressed. History has shown that government shutdowns may generate volatility in the short run, especially as jobs and inflation data are delayed, but any decline in the markets tends to recover quickly. From our perspective, we continue to watch the data and believe underlying trends point to cooling but stable economy, allowing the Fed to cut rates 1 to 2 more times this year and continue towards policy normalization into 2026. Over the past 18 months, we have maintained our 10-year forecast at 4 to 4.5%. We now see a path for longer-term rates to gradually move lower, and we have revised our range down to 3.75 to 4.25. Finally, we remain broadly positive on fixed income and see the potential to add to what has already been a strong year across the various markets. While we continue to remain cautious on corporates where credit spreads remain tight, we expect carry will be the dominant driver of return over the near term. Additionally, municipals continue to offer compelling opportunity with strong credit fundamentals, heavy supply, and attractive tax-adjusted yields. Thank you for watching this month's edition of Fixed Income Perspectives. Feel free to reach out if you have any questions.